You're listening to The Real Investment Show.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark.
And welcome back to the show this morning. I'm your host, Lance Roberts. Michael Lebowitz, CFA, joining us this morning as well in the show. You know, interestingly enough, this morning there was a survey. And they went and they looked around the world, right? And they looked at what people have been buying in 2020. And the top three things are pretty much baking goods, right? Detergent.
Yeah.
And toilet paper.
And alcohol. And it makes complete sense, right? Kids are home all day, so you're baking freaking cookies so they'll shut up and do what they're going to do. Then you got to wash all their stinky clothes. And, of course, by 10 o'clock in the morning, you're drinking. So it makes complete sense.
It all fits.
That is exactly what people have been spending money on. Detergent, baking goods, and alcohol. So,
toilet paper must be number 4.
It must be number 4 on toilet paper. And by the way, you better get out and buy toilet paper because all these counties now are starting to lock back down again, which means the big toilet paper run of 2020 is about to take off again.
Now, technically, with all that alcohol content, wouldn't that be considered? Could it be considered a cleaner?
You know what?
I'm just saying.
President Trump talked about it.
Yeah.
You know, just to inject enough alcohol. You know what? If you drink enough alcohol,
you don't need the rest of it.
COVID really doesn't matter at that point. I mean, let's be honest. There's only one cure for COVID. That's more alcohol. Anyway, good morning, Mike. How are you?
I'm doing great. How about you guys?
Good. So a couple of things. You wrote a really good article yesterday talking about do you feel lucky? And, this it's talking a little bit about value and valuations more importantly. And I wanted to kind of talk a little bit about that because it was some pretty revealing, data in that article. But you have to before we talk about valuation, we've got to kind of step back and talk a little bit about value itself. And, here over the last, couple of weeks, really since the announcement of the Pfizer vaccine, all of a sudden it's been, oh my gosh, we got to get into the value trade, right? We got to buy value stocks. The problem with that is that you're potentially buying companies that aren't necessarily valued.
Right. It's become this word that people either assign you're either a value or a growth company. Mm-hmm. It's kind of like fast food, or it's like restaurants. Just because it's fast food doesn't mean it's cheap. Right. There's good fast food, there's bad fast food, there's cheap fast food, there's kind of more moderately priced fast food.
Right.
You can't lump all these, in our case, all these stocks into quote unquote value. In theory, everyone will tell you that energy is value, that banks are value, that some staples are value, and those are traditionally value. Utilities are value. But that's just historically the way people think about things. What you have to do is do the math and see, okay, if they're value, where are they priced? Can I get them at a low enough price that even if the economy is bad for the next 5 years, that even if this, even if that, they are still underpriced. It's just like buying a house or buying anything else you buy. You want to buy the cheapest house on the block. That's the value.
Right.
It's not the house that used to be the cheapest and everyone thought was the cheapest, but is now very expensive.
Right.
Right. So everything gets lumped into this value trade and passive investing, where people just buy an ETF because that's how you buy value these days. Mm-hmm. It's just exaggerating that trend.
Yeah.
And there is value. Don't get me wrong. And, we think there's some good value in the energy space. But you got to be careful and you got to do your homework and you got to find that value.
Well, and again, this is really critical here because just because a company may seem to, and this is also the other side of this, there's a lot of companies out there, particularly in the energy space, that are trading below $15 a share. And so people go, well, that's cheap, right? $15 a share. That should not necessarily, a cheap price does not mean a cheap investment. And those are two very, very different things. And again, because of what we've done here over the last decade with suppressing interest rates and lots of stimulus and all these type of things that we've done with QE, there's, almost 25% of the S&P are what we call now zombie companies, right? And these are companies that require debt just to stay in business. And if they can't get cheap debt, they can't stay in business. And unfortunately, a lot of those companies reside where? In the energy space. So you've got to be really careful about what companies you buy in the energy space. And again, just buying XLE or an energy ETF doesn't necessarily mean you're buying value. And again, a lot of these value companies depend upon some very important ingredients. Example, you said financials. Financials seem to be a value trade, right? Because they've been suppressed, they've been lagging the market advance, so they're obviously a value stock because they've not performed as well as the market. Well, that's not really the case. A lot of these banks require higher interest rates to make more revenue and income, and interest rates can't go up. So that's a problem. Energy companies require a stronger economy. Basic materials and industrials require stronger economic growth. And, this is something that you talked about in your article that may or may not be coming.
Right. And when you look at value companies, you kind of have to assume the worst. What happens if the economy is flat for the next 5 years? Mm-hmm. Is this company still at a low enough price that it can withstand a bad environment? And a true value company is cheap, meaning that who cares if the economy doesn't grow? This thing is so cheap, it's going to spit off cash flows, and it should make me money. Maybe even pay a nice dividend in the meantime. But now, everything's a fad. The fad this last week has been value, right? And all these investors that don't even know how to look at an income statement or balance sheet are buying value. Right. They're buying energy stocks without doing the math. And we do like energy stocks. Some of them, not all of them, some of them. Right. There's a lot of very dangerous ones out there too. And unless you're going to go through and do the math, be very careful about buying value.
Right. Well, and again, why wouldn't I buy value? Because, the media has been telling me all week to buy value.
Right. Just like it told you to buy Tesla, and just like it told you to buy this and that. And you know what? The media has been right, and the narrative has been driving the market. And there's a lot of, I'm actually writing this for next week's article, there's a lot of 15-year-olds, like my youngest son included, that are asking me, why wouldn't I buy NEO?
Right.
Right. And I ask him, I go, it's losing money. They have debt. It's a Chinese company. That there's issues with trade wars. But Dad, it goes up every day.
Yeah.
Like, okay.
Yeah. No, it is very much the case. I mean, this is but this is part of that cycle of the market that we're in, right? And we see these cycles of markets, time and time throughout history, and they always end the same. There was an interesting, chart out this morning talking about, they did a survey of men and women, and they said, how do you invest? And how do you think about investing? And like 64% of the men that were investing said, well, it's like a game for me. It's like gambling, right?
I saw that.
So you saw that, right? So it's so there's three different responses talking about how do you feel about it, right? It's like a game, I just do this for fun. It's a hobby, that type of stuff. None of it was, hey, I'm doing this to build wealth for my future. Right. It was none of it. That didn't even cross the spectrum of why people invest. But this is why. And this is, if you're listening to the show right now, you're like, yeah, but Lance, Mike, man, the market's been going up for, the last year. Right. I mean, we had this crash in March, and now we're back to all time highs. What are y'all talking about? If the markets work, I just want you to think about this one thing. Right. If markets worked the way the media tells you, and the way that you think it works here in the last couple of years, then why is it that 80% of Americans have less than $500 in the bank? I mean, if the market worked the way that we're told it works, and if people did what the media told them to do, wouldn't like everybody in the country be, have multi-million dollar portfolios after, 30 years of a bull market from 1980 to present, right?
Right.
But that doesn't exist. So that tells you something isn't quite right? I mean, it tells you something's not quite right.
Right. And let me add another angle to that whole thing. Right. When we have a whole big market and there's millions of buyers and sellers, and there's three people that are gambling, who cares? Right. They don't dictate anything. They don't dictate price. They buy, they sell. They have zero effect on price. But over time, when the speculators, and I'm not even saying investors, the gamblers, the speculators, become the market, because they've pushed out all the people that are looking for value, all the people that are looking to sell that which is expensive and buy things that are cheap, they're pushed out. The market temporarily is being driven by that mentality, being driven by the media, being driven by what their friends tell them is a great company that's going to go to the moon and they're going to make a ton of money in the next week. And that is temporarily what's driving the market. And I keep using the word temporarily because this is temporary.
Right.
This is not the way things will work. It can't work this way.
Well, and again, this is what really, and when we come back from the break here in a second, we'll again kind of get a little bit more depth into your article about do you feel lucky? Because, when we start looking at where we are in the cycle of investing, this is one of the reasons that we raised some cash on Monday. Now, I want to be real careful here because every time I say we raised cash, everybody assumes we sold everything and we're sitting only in cash. We took profits on Monday. I mean, we just reduced our risk levels in our portfolios a bit because markets are extremely extended. They're overly bullish. I mean, we saw massive surges in bullish sentiments in a week, right? Just since the election, all of a sudden, the American Association of Individual Investors just surged in bullish. They haven't been bullish all year. All of a sudden, they're at record bullishness in the matter of a week. When you see that type of activity, it typically tells you that markets have kind of priced in, quote unquote, all the good news, so to speak. And, that leaves risk to the downside, which is why we took some profits off the table. But on a longer term basis, you also have to look at what the market is telling you about where we are and, what potential returns are going to be in the future. And this really comes down to this whole idea about the quote unquote value trade. There really is no value in the market. And we'll talk about that when we come back and talk about why, if you're investing now, you better be counting on being lucky at this point. Don't go away. We'll pick up more with Michael Lebowitz right after the break. Don't go away.
The fire's in your eyes and the words are really clear, so beat it, just beat it. You better run, you better do what you can. Don't wanna see no blood, don't be a macho man. You wanna be tough, better do what you can, so beat it. But you wanna be bad, just beat it, beat it. No one wants to be defeated. Showing out lucky, strong is your fight.
Listen anyplace, anytime at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.